In April, we formed a new joint venture with a leading investment firm involving our 8 hospitals in the Salt Lake City area, operated by Common Spirit. We hold an equity investment of approximately $100 million, representing our 25% share of the JV. I will also point out portfolio, about $14 million.
All right, guys, I'm back. I'm going to try to get back to the point where we left off or close to it. Yeah, I know, it's a great time. So it's paused here. I renamed it Part 2. No. I have no volume. Are you sure about that? Because I have the actual call paused, waiting for people to come back in. We're roughly at the point that the last one left off. Okay, cool. Just waiting for people to pile back in. Oh, crikey. People need the link. All right. So I think they were still talking about the stabilized portfolio when I got rudely cut off by my internet provider. I think Fraser Pairing might have come out and cut the cord on me or something like that. So, all right. It may not be exactly where the last one I'll talk, because it's hard to say exactly the precise moment my internet went out. But, yeah, we might have like a minute or two of stuff that we already heard. But, yeah, here we go.
In the second quarter, representing MPT share. Subsequent to quarter end, Steward has paid for the month of July approximately $10 million in consolidated rent and $9.5 million of consolidated rent, of which our share is 50%. With regard to G&A, the increase from the first quarter is due to the timing of stock award grants, resulting in only a partial quarter of expense in Q1. Excluding stock compensation expense, G&A is flat with a quarter and lower than the 2023 second quarter. I will point out that the majority of this non-cash share-based compensation expense is related to performance-based awards that will not pay out unless our share price appreciates substantially from the price on the date of the award and as of today. In April, we formed a new joint venture with a leading investment firm involving our 8 hospitals in the Salt Lake City area, operated by Common Spirit. We hold an equity investment of approximately $100 million, representing our 25% share of the JV. I will also point out that we will record our share of the JV earnings on a quarterly lag basis, with the first quarter of reporting being the third quarter of 2024. Approximately $550 million in non-cash impairment charges were recorded in the quarter, primarily related to the full impairment of our equity stake in the Massachusetts partnership with Macquarie. These charges were estimated and recorded pursuant to U.S. GAAP accounting rules and reflect conservative assumptions regarding potential recoveries. We currently have approximately $440 million of secured non-real estate investments in Steward and $2.3 billion in real estate that is expected to be released or sold as part of the ongoing bankruptcy process. We believe these investments are fully recoverable at this time. However, no assurances can be given that we will not have any additional impairments in future periods. I will note a couple other adjustments to normalize FFO. First, we adjusted downward by approximately $163 million the book value of our investment in PHP Holdings based on the latest third-party independent appraisal. It is important to note, however, that this adjustment does not necessarily reflect the ultimate sales price that Prospect expects to obtain from any prospective purchasers. Second, we recorded a small favorable adjustment related to the fair value of marketable securities, such as our shares of Uvis. With that, I will turn it over to Steve for a discussion of liquidity and our overall capital allocation strategy. Steve.
Thank you, Kevin. On our last quarterly update call, we expressed our belief that we would exceed our $2 billion full-year monetization target. And as Ed just pointed out, we have now executed more than $2.5 billion in year-to-date transactions. Very importantly, virtually all of these, a total of roughly 50 hospital facilities in 5 major transactions, have been executed at very attractive valuations, whether that's based on capitalization rate, IRRs to us, real estate replacement cost, our initial investment, and almost any other valuation metric, particularly in light of the diminished values that other real estate categories have suffered during the same period. These transactions have provided liquidity that we have used to pay down $1.5 billion of debt in the second quarter, enabling us to fully pay all 2024 maturities and address all of our 2025 scheduled maturities. As a result of our success executing this liquidity strategy, we received overwhelming support from our bank lenders to adjust our revolving credit agreement to provide a long runway and covenant cushion as Steward continues to pursue the sale and retenanting of its hospital operations. There is long-term value in the majority of our hospital real estate currently leased to Steward, and we expect to retain that value as we replace Steward with new tenants or sell assets to quality operators through the court-supervised restructuring process. We appreciate our lenders' recognition that we do not control the timing of this process and the additional flexibility afforded by this covenant cushion during the restructuring process. We filed an 8-K this morning that describes key provisions of the amendment, so I will only briefly summarize a few points. First, on last quarter's call, we discussed the temporary waiver of the loan provision that limited the value of certain assets leased to tenants in bankruptcy to 10% of total unencumbered assets. At that time, the waiver was effective through the end of this current quarter, third quarter. This limitation has now been waived for 14 months through September 30, 2025. This generally means that our real estate leased to Steward will remain in that calculation until then, and our expectation is that virtually all assets leased to Steward will have been sold or transitioned to other operators within that period. And although there are no assurances, we certainly expect that will happen sooner rather than later in the period. Second, given our current priorities and the liquidity generated from asset sales and financing transactions already executed and available in the future, we further reduced our revolving credit commitment to $1.28 billion. We just do not need the multi-billion-dollar facility that was available to us during the years of rapid and significant growth. Third, the amendments also provide headroom all the way through next September of 2025 for certain financial covenants. These modifications will preclude the need to continually evaluate and adjust for the effects of the Steward transitions, including sale prices, lease terms, any rent deferrals, etc. Again, these are described in this morning's 8-K. I will highlight that the consolidated net worth covenant has been permanently adjusted to $5 billion, and that can be compared to the $6.2 billion of GAAP net worth we reported as of the end of the second quarter. Other changes that are effective through September 30, 2025, are to increase the allowed total leverage to 65%, increase allowed unsecured leverage to 70%, and reduce the required unsecured interest coverage to 1.45 times. We believe that each of these covenants gives us cushion that anticipates the Steward retenanting selling outcomes, and as of June 30, which is the effective date of the amendments, we are well within each of them. Finally, we agreed also that unless we elect to terminate the amendment provisions ahead of next September 30, we will limit to 8 cents per share per quarter the amount of cash included in our quarterly dividend payments. Based on this morning's reported quarterly results and recent market share prices, this would represent a normalized FFO payout ratio of about 35% and a dividend yield of about 7%. If our REIT taxable income requires a payout in excess of the 8 cents per quarter, our board will determine which additional dividend alternatives are most appropriate at the time. These covenant amendments, again, are generally effective through the end of the third quarter of 2025. That is certainly not a prediction that it will take more than a year to transition our Steward leased assets, but is an indication of the assessed strength of our business, especially that of the non-Steward portion of our assets. For our fixed income investors and shareholders, the key takeaway from this amendment should be that we have repeatedly proven, especially to our lenders, over the last couple of years, that our hospital real estate portfolio is strong and liquid and readily available to strategically monetize in the event we elect to do so. And looking through calendar 2025 into 2026, our expectation is that we will have a stable portfolio of hospital real estate leased to key operators in their respective markets with no exposure to Steward. We expect to have multiple options to satisfy maturing loans, including refinancing, additional monetization of high-value real estate, and other strategies. And with that, I will turn it back over to the operator for questions.
Thank you. We will now begin our question and answer session. To ask a question, you may press star then 1 on your touch-tone phone. To withdraw your question, please press star then 2. We ask that you please limit yourself to one question and one follow-up. At this time, we will pause momentarily to assemble our roster. And the first question will be from Austin Wurschmidt from KeyBanc Capital Markets. Please go ahead.
Thanks, and good morning, everybody. Ed, can you expand on your comments about expecting positive results in the Steward, from releasing the Steward assets, and just give us a sense how those negotiations are going, comparing kind of the in-place contractual rent today with Steward versus what you expect to achieve, and then also share, what % of the facilities leased to Steward currently have an operator lined up to take over operations at the appropriate time.
So, Alton, I absolutely would love to, but we're under a court confidential order, as are all of the other participants in this bankruptcy process. And other than my prepared remarks, that's all I can say at the moment.
Is there anything that you're able to share about % of assets that you would expect to sell out of the $2.3 billion of total real estate investments?
All I can say is that there will be a combination of sales and re-tenanting.
Okay, got it. And then how should we think about what the quarterly cash rent and interest payment from Steward should be for the third quarter?
Austin.
Just a second. So, Alabama, because it's an Alabama-based company. That didn't factor into the thesis at all here. So they're about to they just got asked directly about the cash dividend versus other stuff. So please listen carefully on this answer.
And Steve here again. It's something that is moving rapidly, literally day to day, in the bankruptcy procedures, and we simply don't have the visibility into the evolution of either assets sold or re-tenanted, and if re-tenanted, what the cash lease rate will be, if there's any deferral, if there's any ramp up. So we simply don't have the confidence to give any precision to a prediction.
Okay, thanks for the time.
And our next question is from Joshua Dennerlein from Bank of America. Please go ahead.
Yeah, hey guys, thanks for the time. I guess just thinking through the lease rejection in Steward Mass portfolio, just how do we get comfortable that wouldn't happen across the rest of the Steward assets, or maybe just even the broader portfolio if there are other BKs? Just seems like it might be like one of the easier parts of the capital structure you could like adjust or kind of wipe out if you can't flex. I'm assuming it's hard to flex labor costs for hospitals. So just kind of how can we get comfortable that that might not happen?
So I'll just point out, Josh, and thanks for the question, different than everything else, just by virtue of its structure, including it's a joint venture that we have with Macquarie. You all know that. And very importantly, there's secured non-recourse financing on those assets. And that limits, of course, the true equity value is not necessarily nearly as much as the gross value of the assets. And then finally, again, within the constraints that Ed just described about confidentiality and mediation. And
okay. And then on the Ed, you mentioned mass situations causing some like noise with like potential buyers. What is it that like maybe spooked them, and like what are they waiting for to kind of maybe come back and relook at some of the assets?
Josh, maybe you misunderstood me, but that was only in regard to Massachusetts.
Oh, okay. That's fair. Thanks, guys.
And the next question will be from Vikram Malhotra from Mizuho. Please go ahead.
Morning. Thanks for taking the questions. I guess, you've given us some, thoughts around Steward. The rest of the portfolio, given sort of we're, I guess, coming close to an election, there may be more changes on the regulatory front towards hospitals, payments. I'm just wondering, are you able to sort of maybe give us some color on any of the other tenants that may be sort of close to kind of one times, or anything that you may be monitoring from a watch list perspective, just as we model kind of the second half into 25?
So, Vikram, it really only remains the one tenant that we talked about in the last quarter, which represents around 1% of our total portfolio. From our standpoint, the properties that we have with them continue to perform okay. They have some properties that are not associated with MPT that they're in the process of selling. And other than that, there really aren't any issues in the portfolio.
Okay, that makes sense. And then just, on the CapEx side, I think it was about $100 million. I'm just wondering, and maybe that was also development. I'm just wondering, like, on a go-forward basis, second half, and maybe if you can give some color or thoughts into 25, how do you anticipate that CapEx, both maintenance as well as development CapEx, trending into next year?
So the vast majority of that continues to be the two facilities that we have under development related to Steward, one in Norwood and one in Texas, in Texarkana. Excuse me. You may have seen in Massachusetts that the Supreme Court ruled favorably on the definition of the storm damage there in Massachusetts. So we expect to have additional insurance relief there. We continue to have good interest in both of those facilities on a go-forward basis, and believe that they will be completed and released to someone other than Steward.
Thank you.
And the next question is from Michael Carroll from RBC. Please go ahead.
Yeah, thanks. Just following up on your last comment regarding the Norwood Hospital, Ed. I guess those insurance proceeds, I know it's been kind of stuck in court for some time now. I mean, do you need to go through the appeal process? I guess, what's the timing of that happening, and is there a potential of a settlement occurring where you can get those proceeds sooner?
Okay, so this question is very important, and some people may not have been following this situation if some of you aren't in the Discord, but he just asked about Norwood. There was an important dispute with the insurance company because the hospital had a lot of water damage, some of which was apparently from water coming through the roof of the hospital, and it's basically just destroyed the building on the inside. And the insurance company tried to cap the payout, saying that it was flood damage, but a judge recently ruled that the water that came through the roof is not flood damage, essentially, or groundwater, I guess, is how they might have worded it in the case. But It's possibly a couple $100 million to MPT, depending on the outcome. So want to hear this one for sure.
So you're right. We do have to go back to the lower courts. The Supreme Court ruled in our favor on the definition of the storm damage, and I am not going to try to make a guess on what the next timing will be. But it was a very favorable ruling for us.
Okay, great. And then just wanted to touch on the credit facility amendment. In the 8K, it mentioned that MPW is required to repay outstanding amounts from certain proceeds from asset sales and debt transactions. I mean, what does that mean? I mean, if you have a big asset sale, does 100% of those proceeds need to go pay down that credit facility? And can you pool on that credit facility right now? Is there any limitations on you pooling additional funds from the available from the availability under the facility?
No, we have access to the facility, and what your initial question, a certain percentage. And I think it's public in the document we'll file, is 50% of net cash proceeds from certain future asset sales. Initially, are targeted to pay down. You may recall we have a sterling-based term loan that's due in January, so that will be prepaid with any additional property sale cash proceeds.
But you don't lose the capacity once you pay down the availability?
On the line, that's correct, yes. Just to be clear, paying down the sterling term loan, that's permanent, because that matures in January of 25. But paying down on the line, we have full access to redraw under the line.
Okay, thanks.
And the next question is from Mike Mueller from J.P. Morgan. Please go ahead.
Yeah, hi. Since it seems like you can't talk about the go-forward mix of sales versus releasing for Steward, can you remind us, at the beginning of this, what was the total investment when Steward filed? What have you addressed of that investment amount so far, and what do you have definitively locked up? And I guess, including the give-backs as well.
Well, Mike, the only thing that's definitively complete, as you point, and it's not even definitively complete, we do expect that we'll relinquish our interest in Massachusetts, but even that is not subject to definitive agreement yet.
Okay. Got it. So it's basically that. And then second question, any update you can give us on, with Prospect, the Yale sale, back and forth, and anything on the monetization timing for the managed care business?
All right. I want to do a call out on this question because I don't think they said anything unless we missed it when my internet went out.
Good day and welcome to the Medical Properties Trust second quarter.
Okay, the call must have ended while I had it paused and started over again. So I'll try to get back to where we were at here before, but the Prospect Yale New Haven thing, that was Prospect had agreed and MPW agreed. They basically came to terms with Yale New Haven in, I think it was, I want to say Connecticut, to sell some Prospect hospitals for a nice chunk of change. And more recently, they've had buyer's remorse about it. And Yale New Haven, they've basically tried to back out of the deal with Prospect or get a big discount or something like that. It's kind of shisty, to be honest with you. Now let me see if I can find that question again.
In Massachusetts, so we expect to have additional insurance relief there. We continue to have good interest in both of those facilities. You may have seen in Massachusetts, and other than that, there really aren't any issues in the portfolio in both of those facilities.
LAKEY mentioned that MPW is required to.
That will be prepaid with any additional property sale cash proceeds.
but you don't lose the capacity once you pay down the availability?
The go-forward mix of sales versus releasing for Steward. Can you remind us, like at the beginning of this, what was the total investment when Steward filed? And then second question, any update you can give us on, I guess, with Prospect, the Yale sale back and forth, and anything on the monetization timing for the managed care business?
So on the Connecticut Yale sale, we don't have any update. Not going to make any guesses. I think it was roughly a year ago this time that I quit trying to guess what the timing of that situation was going to be. On the PHP sales, I believe they are expecting final bids this month, and then we'll pick a winner and move forward to closing.
Got it. Okay. Thank you.
And the next question is from Michael Lewis with Truist Securities. Please go ahead.
Great. Thank you. Ed and Steve, you both talked about, the options available to you for refinancing debt or addressing debt over the next couple of years. I see about $3 billion total in 25 and 26 at a 2.8% interest rate. Should we assume that, most of that will be addressed through property sales? Or, what are kind of those other options that you've been exploring or that you alluded to?
Well, the options are existing liquidity. We've talked about that. Further asset sales if necessary, although we have nothing to discuss or announce at this point. At some point, we do expect to be able to refinance, then normal conventional refinancing replacement as we get through the uncertainty of the Steward situation.
Okay. You think property level debt, or maybe it's too early? You don't know what the public market will offer?
We have no further plans for that. We certainly have capacity. You saw what we were able to achieve on the Circle assets, a sub 7% fixed 10-year non-amortizing loan. More of that is available, but that's not our number one or number two or probably even number three priority. We'd like to come out of this after resolving Steward, remaining an unsecured borrower, but those values certainly are available. I guess that's the point I would reiterate. We have a number of levers that we've already pulled, exceeding ours and frankly anybody's expectations in frankly 6 months. More of those levers are available, but we also believe that we'll be able to address 26 and beyond maturities with more conventional means.
Okay, understood. And then my second question, just on the liquidity transactions you've already done, the $2.5 billion plus. What is the quality and the yields of those assets kind of representative of the rest of the portfolio? And I'm thinking a little about if the sales are strengthening or weakening the overall risk and growth profile of the portfolio.
No, I don't think so. And I think if you look back across going all the way back into early 2023, which would include the Australian transaction, we've sold assets across the globe. Across our property type spectrum, across the operator type, and gotten a very, very good sample of the overall portfolio. And as I pointed out earlier, in every situation, in every one of those transactions, we've achieved very, very strong valuation. And I don't think, in fact, I feel confident that we haven't diminished the overall quality of the remaining portfolio. That was really the point of my comment, that if we need to, if strategically we decide to sell more, we think we have a very, very strong portfolio that would achieve similar valuation. I think that was the point of your question.
Yeah, that's great. Thank you.
And the next question is from Omotayo Okusanya from Deutsche Bank. Please go ahead.
Yes, good morning, everyone. I just wanted to clarify on the dividend. Is the way it's going to work going forward is it's going to be 8 cents a quarter cash, and that's going to be the number unless, of course, you need to meet your minimum dividend requirements. And then if there's any increment that has to get paid out, then that gets paid out in some other alternative form, such as stock or something of that nature. Is that the way we should be thinking about it?
No, I don't think so, Tayo, because the dividend, the next dividend hasn't been set. It will be set in the ordinary course. All we're saying is, obviously, we have to pay a dividend. We will maintain our REIT status. I think that goes without saying. And of that dividend, whatever and whenever it may be determined, only up to 8 cents a share per quarter can be in cash.
Thank you for that clarification. And then one other question I wanted to ask is just in regards to Steward and assets that may be transitioned to other operators. How does it work? Or could you just kind of walk us through how exactly would it work? If Steward again rejects the lease, between that period of them rejecting the lease and when you get a new operator in there, because I think you might be going through that at North Shore already in Florida.
So, Tayo, let me remind everyone that the remaining properties are all under one master lease. So for Steward to reject that lease, they would have to reject them all. These are very valuable properties, not just for us, but for Steward as well.
Gotcha. Okay.
And ladies and gentlemen, this concludes today's question and answer session. I would like to turn the conference back over to Ed Aldag for any closing remarks.
All right, fast, Eddie.
Thank you, Chad. And again, I appreciate everyone being on today's call. I wish we could have given you more detailed information on the Steward bankruptcy, but I do want you to listen to what I said in my prepared remarks. We feel very good about where we are and look forward to getting this resolved sooner rather than later.
And thank you, sir. The conference has now concluded. Thank you for attending today's presentation. You may now disconnect.
All right. So yeah, the 8 cents cash dividend, people aren't probably very happy about that one, but I honestly would have expected the stock to drop a lot more than it did on that news. So, I guess could be worse. Now, that does only apply until there's some kind of resolution in Steward. Also, Massachusetts is a completely separate beast from the rest of the Steward portfolio. I think that's an important thing that they reminded everybody of there, because of the fact it was structured as a joint venture and because the regulators in Massachusetts are so damned stupid. I've been saying this for a while now that I think Massachusetts is going to be the worst of the lot. And I think that that's borne out. If you're not reinvesting the dividend, what would happen? Nothing would change. You'd just get less cash. Or a stock dividend would give you a little bit more shares in the stock, basically. Yeah. So a stock dividend would be like, I've seen, there's this BDC called it's SSSR, I think is the ticker. I think they were an early investor in Palantir, if I'm not mistaken. And when that IPO'd, they had a special dividend where you could elect to either take cash or stock. And if you took stock, you just got more shares of that BDC, basically. And they're obviously in MPW's case, it's not going to be an option. We just take what they give us, essentially. But you would just get more shares. And if they decided to get us to keep the same nominal yield, it would be 7 cents worth of MPW stock per share, which would mean for every 100 shares you have, that 7 cents would be something like 2%. So yeah, you'd get like a couple extra shares for every 100 shares you have, something like that. So I think the important thing with why they might do a stock dividend is I think the shorts would still be like required to cover it on the shares that they have sold short. That's an interesting scenario, and I'm not sure what that actually looks like. Maybe the thing is, we're probably looking at rate cuts soon from the Fed, which generally speaking, I would think would drive money into REITs and improve their conditions on refinancing and improve the values of the underlying properties, meaning cap rates would get lower and potential asset sale prices would get higher. Generally how things work when rates go down. I mean, you guys are talking about, the shorties pushing or whatever. But, I mean, the stock down 1.85% today. Like, so far, that's a nothing burger. I mean, granted, yeah, it could always have a weird shift towards the end of the day. But, like, the pre-market whipsaw of it going to under $4 was insane. I woke up to those notifications and I thought this was going to be wild today. Yeah. But it ended up not being so bad. So, yeah, people obviously based on the actual press release probably thought that this call was going to go a lot worse than it did. So it's a funny thing about expectations, even though, like, as a shareholder, I don't feel like this was a great call, to be honest. Like, there are some people obviously out there on Yahoo and whatnot that'll probably try to spin every single aspect of this call as positive. Oh, well, if it isn't the Ryan Dengler Show, my co-host on Cashflow Kings Live. By the way, we're going to be having an MPW roundtable, speaking of Cashflow Kings, on the Cashflow Kings Live YouTube channel on the 17th. We plan to have multiple MPW investors there to give their perspectives on today's results and conference call and anything up to date by that point with the Steward bankruptcy and how that's developing. So you need to subscribe to the Cashflow Kings Live channel. What can I tell you? Oh, I'm not the cult leader anymore, apparently. News to me. It's good to see Coyote back. You know, I would definitely like to see you potentially come to the roundtable. Are you on Discord? If you're not on Discord, link in the description. Vici, yeah. I mean, what could ever possibly go wrong in Vici? You should definitely join. I mean, you've been kind of an OG on this journey for a bit. I know you got out of the stock and then back in for a little bit. So be there on the 17th. It's going to be 8 p.m. Eastern on the 17th. Cashflow Kings Live link, I believe, is in the description. So Ryan has a good point. MPW is rarely making an appearance on the 3 stocks to buy now videos put out by most financial YouTubers. That's true. Back in at 390. You know, your timing is really good. I wish I got out at $7 and then back in at 390. So, yeah, Schwab is obviously buffoonery. If you have a margin call, obviously it's Schwab's fault. If Schwab shows that your dividend income comes down, it's Schwab's fault. So Vegas could get clobbered with natural disasters. That's true. Like the unbearable heat. And also there is possibly tourism could take a hit with some potential issues. Like if we see rate cuts from the Fed, it's probably because unemployment numbers have gone past the target and it ain't going to be pretty for anything that's kind of discretionary. The reason I like healthcare is it's not discretionary. Well, it's not. if it's actual like acute healthcare and stuff, at least it's not discretionary. There's, I guess, elective things that you can put off, but yeah. But yeah, it seems like we're still in for a bit of a long slog on Steward. I think maybe we were a little bit rambunctious earlier in the year, thinking that a complex Chapter 11 like Steward's would be like mostly cleared up by this point. That was probably slightly naive on our part, so yeah. Well, sometimes your gut can be right, that's for sure. Actually, the funny thing is, I opened up Schwab this morning expecting to be just completely obliterated because I saw all the alerts of the stock MPW going down, and I was actually doing okay, even with that initial drop, because like everything else kind of recovered a little bit today. But yeah, imagine if you were all in on margin in Tesla right now. My butthole would be puckered to just, give you an image. Oh, look, Tesla's up 3.6% today. Looks like he saved from his margin call for the moment. Yeah, I'm pretty sick over Intel too. Whoopsie doodle. That's a bad one. Though not necessarily entirely outside the realm of what could be expected with how much they're spending on CapEx and everything. It should be it was a known value that it wouldn't be pretty during the period from like 2022 to 2027, but boy did I underestimate how ugly could get. Like I was thinking maybe it was like a 3-on-10 ugly, maybe like with beer goggles, it's not so bad. But no, it was pretty horrific. Yeah. Oh. Well, congrats on, potentially having some real assets if Rob Simone's patented 80% write down on everything doesn't come true. All the laws, yeah. I mean, I don't think EVs are going away necessarily. I don't even think Tesla's going away necessarily, but is it worth today's price? I mean, how much of it is like the cult of Elon knob schlobbers that are in Tesla? Yeah, versus people that are actually coming up with like a realistic projection for what the company is actually capable of producing in the future. Like, meet Kevin. I think they'll be doing $6 trillion of revenue and trading at 100 PE in 10 years. Like, no, Kevin, you're a retard. Oh, am I allowed to say that? Well, anyway, so yeah, it is a classic move. The 80% write down. But all in all, yeah, okay, Crashy would. So no, I'm talking about Meet Kevin, the YouTuber. He famously in 2019, 2020, something like that. I think it was maybe even later, but he had a valuation spreadsheet he made specifically for Tesla, and was projecting that in X number of years they would be doing like trillions in revenue and trading at like 100 PE or something, and like the market cap at that point would be like 60% of the US GDP or something. It's like obviously on the face of it completely absurd and stupid, but people actually take Kevin seriously for some reason. And he decided also to run for governor because of how important and serious he thinks he is. Seems like a total narcissist and not actually all that smart, but it is what it is. He's not like an actual material expert in like anything except for real estate, I think. And he sells courses too, which obviously you all know how I feel about course sellers. That's how you'll know I'm in my villain arc, is if I come out with a course. So I think most of the people in here probably drip. I don't drip. I prefer swag, if you get the reference. But no, I don't drip. I collect all my cash and then allocate it in whatever I think is best, which usually ends up immediately going down right after I buy it, of course, because I just really know how to time the market and pick stocks. Yeah. So I think I'm going to wrap this because, I want to see about a couple other things I need to look at today. So, oh yeah. I mean, like so before I do go, I want to bring that up. Stabulo just said that I must have the worst luck in timing ever, which I do think that is partly true. Like I saw MPW as like a value situation, but my initial entry point is like I started coming in with my like first 100 shares, so I have a lot more now at a much lower average than this, but 100 shares at like $10 or something, because I was like, I think this thing's worth like 14. And obviously it could, some people still think it's going to get back to 15. The guy from Fast Graphs keeps saying he thinks it's worth 18. I mean, I don't know if he said that lately, but I think 18's too much. I genuinely don't think MPW is worth $18 today. 15 even, like, that's kind of a stretch now with the way some of this stuff has shaken out. The shorts, of course, will tell you it's worth 0, which obviously I don't think that's true. But $11, $12 probably is what it's actually worth at this point. Maybe even a little bit less. I don't know. That's my sense of it. Yeah, the fast graphs value trap. So anyway, yeah, my timing not necessarily great. And of course, I got into Intel early 2022 initially. Again, my basis went down over time, but I saw it go from 47 to like 24, back up to like 50. And at that point, I was like really in the green on it and probably should have just taken my win. But what are you going to do? Also, High Tide had like a really good earnings report, and I had been buying all the way up into it. And then instead of going up after a really good earnings report, it just slowly bled off after that. I guess it does that regularly, and I wasn't I wasn't aware of the pattern or whatever. I just bought what I thought was a good company at a good price. It's a small cap, so it's pretty volatile and prone to do weird things. So that is what it is. Am I getting out of what? We haven't talked about just. Do you mean MPW? Because no, I don't see myself getting out. Like, even the market didn't really like react too badly to this earnings call. So yeah, like I was fully, I was like, what am I going to do if this is, if this is actually below $4 again? Although, yeah, I'd probably just hang on and die on the hill, you know? I've been known to do that from time to time. I'm pretty stubborn, and I don't move easily. Like, I'll complain. I will bitch and moan on Discord when I'm having a bad day, but generally speaking, I'm pretty stubborn and reluctant to sell. I did take a win on Palantir. That was a 4x. Definitely wish I had many times the number of shares I did, but that was like the one where I got timing right. I guess you could say almost bought the bottom on Palantir. But went small because like I genuinely I don't have a really tremendous understanding of what their software actually does. And it's a little bit of like a black box situation because I'm sure they closely protect the secret of how all their stuff works. So my comfort level in making a big bet on it was small, but I was like, it's $6. It seems like they're financially doing pretty well, and that worked out. All right. So anyways, yes, my timing is bad, and no, I'm not selling MPW. Yes, we're having a roundtable on the 17th. Yes, I still have Intel, and yes, that really sucks. I'll talk to you guys later. Remember to hit the like button on your way out. Take it easy.